Like to invite the moderator of the session, Shri Arijit Basu, Chairman, IMC Banking, NBFC and Finance Committee, Chairman, HDB Financial Services Limited and former MD, State Bank of India. And the elite panel joining him on the days are Shri Joydeep Srinivasan, MD and CEO, Federal Bank Limited, Shri P.D. Singh, CEO, JP Morgan Chase Bank, NA, India. Kindly take your seats on the dais. The session is over.
So, good afternoon to the final session of the day. We've had a very long day and very exciting sessions. Firstly, let me start by welcoming our guest on the screen, Mr. Shyam Srinivasan, MD and CEO of Federal Bank. So he gave me a choice last night.
Recording in progress.
So which was that, if I were to hold a gun to his head, he will take a 1 o'clock flight because something came up in the morning today and come. But he volunteered to come on video in spite of some last minute exigency that he had. So thank you very much. And we would...
Thank you.
Yeah. And to give you company, just to inform you, you have your right-hand man, your director, Mr. Siddharth Sengupta, also present to listen to you and
So I have to be careful what I say. He otherwise he'll trouble me in the board.
Yeah, he will. But welcome. Mr. C.S. Shetty is the Managing Director of State Bank since 2020. And Mr. P.D. Singh is the CEO of JP Morgan India since, I think, the last quarter. He's just taken over. He's a very old and dear friend and represents the foreign bank. Mr. Joydeep Datta Roy is the ED of Bank of Baroda. And we look forward to a very engaging discussion, and I'd like to keep some time open in the end for questions and make it as interactive as possible. Just to brief the panelists and some of us who did not attend the sessions in the morning. So the theme for this year is harnessing banking and finance for India's growth. And the reason I think IMC decided to keep this is COVID went on for 3 years, and at least we feel now that it is behind us. And India and the Indian economy and the Indian banking system, by a lot of data, seems to have done reasonably well. At least if I were to put it in a very balanced way, no one can deny that it has not been a crushing problem and things like that. And we have acquitted ourselves reasonably. But then India is an emerging economy. We are now the third largest economy. However, our income levels, per capita income, etc., continues to remain low. And we want to at first perhaps become a middle income economy, which is why we keep talking of these numbers of 5 trillion, 10 trillion and all that. And now banking and finance has been the key pivot for driving this historically since independence. And that is why the question. And no one better than the bank CEOs. This is a banking and finance conference, so we've left the bank CEOs for the end to tell us, how they feel about this. So I thought we'd cover 2-3 things, starting with the economy, because we can't discuss banking in a vacuum. It's after all the economy, and we had a very good opening session. The moderator of the session, Rumki, is here, in which the economists deliberated and gave us some thoughts on how both the global economy and the Indian economy is doing, and how also it could impact banks. So, for the CEO's perspective, Srinivas, you are MD, and I know now the good thing is you are also in charge of international banking. So, you have both the Indian perspective and the global perspective. So a very broad thought from your side, broad, or you can go deeper as well. as to what are the challenges which India might face, given what is happening. We all know the issues: inflation, Russia-Ukraine war, etc., etc. What are the challenges that India might face or is facing, given the global context and also what is happening in India? If you can start off, then we'll take some other views on this from the others.
First of all, sir, thank you very much for giving this opportunity to the IMC as well as, of course, to you as old friend. On the international front, before I actually talk about challenges, wherever I'm traveling these days as head of international banking in India, I'm in SBI, both for fundraising for SBI as well as, for many of the meetings with the regulators, there's an immense interest in Indian story, Indian growth story in particular. I think it's a fact, as Mr. Basu mentioned, that in the overall gloomy situation globally, India has been a bright spot. But having said that, there's the same question a lot of investors keep asking, everything seems to be good. What is actually going to be the challenges? From a banking perspective, I think we have come a long way. In the last 5-6 years, the way the balance sheets have been strengthened, both in terms of the asset quality, in terms of the provisioning, in terms of the, the incomes. So the banking sector is in a good shape. That is a very first fundamental, what is called the checkbox, which we have to really be mindful of. So, but from an Indian context, if you see if I come back to the banking and finance harnessing the growth of India's growth, the biggest challenge banking is going to face is on the deposits front, on the liabilities front. I think if you have to see the credit growth, which is the way it is growing, where the funding coming from the banks is, most of the banks are funded by 90% by deposits, right? Unlike foreign banks, where the market borrowings are significantly supporting the balance sheet, in India, banks are dependent on the deposits. While during the pandemic, there has been a significant flows into the banking sector by way of deposits and a lower credit growth, that is now actually reversed. I think one challenge I would definitely flag is that how are we going to manage this lower deposit growth over the higher credit growth which is pumping. And if the banking industry really have to support the growth, this is one issue which needs to be addressed. The second and more related aspect is, if you see the shift in the savings, while the domestic savings, aggregate domestic savings have been increasing from 2021 from 29% to 31%, the household savings, there is a shift from a financial savings to physical savings in the physical assets. So if you do not have the accretion of the financial savings from the households, funding the large infrastructure needs, either through the banking or to any of the specialized agencies, is going to be the big challenge. And infrastructure is going to be the fundamental aspect in the overall growth story of India. So I think how we are going to address the infrastructure funding and how you are going to mobilize the household financial savings into the banking sector are going to be the critical features. And third and most, of course, which is not unique to India, is how are we going to address the climate transition, both in terms of the physical risk as well as the transition financial risk. I think this broadly is are the 3 points which I would like to flag on this.
No, I think it's working, right. No, I think excellent point made Srinivas, because these are deposits not growing in the last few years that, when I happened to be in the bank, that was not a challenge because there was no credit growth. But since that cycle is now reversing, the focus has once again come back on deposits and how we address it. And I think the last point that you made on climate, ESG, etc., that will play out in more ways than one. In the sense that we have to raise capital globally, at least on paper, and what people say their standards are changing. Their expectations of investors are very high on the kind of corporate governance and the focus on sustainability, etc. And if we don't get our act together on that. So very good points. And I'd just like to develop this and switch to the person on the screen. So Shyam, Federal Bank, I'm just taking the name because it's a bank which is transforming itself in the sense that we know results are good. But I'm more interested in the composition of the balance sheet. This is a transformation not just for Federal Bank, but for, I think, all banks in India. And now almost everyone is becoming a clone of the other. Yes, we did have a very bad corporate bad loan cycle, which a lot of things went wrong and we had to correct it. But the kind of thinking after that is that corporate lending is to be corporate lending. By corporate, I mean all corporates, corporate, mid-corporate, and even it now extending to larger MSMEs also. Banks should stay away from it. Now, if banks are not, and individual retail is becoming 60% of that. In fact, not Federal Bank, but one of the very well-known private banks, not the largest, but one of the smaller well-known private banks. He's not here, so I will not name him. In one of the similar panels when I was present, he said that banks should not do corporate lending at all. I was actually horrified. This was about 3 years back. So, what is your view on this? It's not from a Federal Bank perspective I'm asking. That is this 60%, if I get it right, 60% of loans that are being extended are now to individual persons, whether they are for home loans, car loans, this loan, that loan. Is that a right mix, and will that be sufficient to drive the growth that the Indian economy wants? That's my question.
Yeah. Thank you very much. Thanks, Basuji. And sorry, I'm not there in person. I'll try and do justice from afar. In specific to the question you asked, for long periods and not very recently, I've held the view that a mix has to be broad-based and balanced and not uniquely retail or uniquely wholesale. If you go back in time, anybody who had excessive focus around I'll do only wholesale or I'll do only retail tend to be seasonal and will shift stance. The same set of people who now argue for retail 3 years back, 5 years back would have argued for wholesale, and the situation will reverse. So I think the nature of, like Mr. Srinivas was saying, banks are funded by retail deposits or individual deposits. So you have some fiduciary responsibility to make sure that deposits are well used and well delivered. But it would be unwise to pivot only to one sector of the business, right? We've held the view that you need a balance, whether it's 60-40, 70-30, 55-45, whatever that is. There has to be some kind of a consistency in the approach. You can't drive the wheels of the economy with just one part performing well and the other not. Now, you may have unique expertise in certain areas where therefore you may give it higher priority, but I have long held the view that you can't be in either retail or wholesale. You need to find a healthy mix around. Within wholesale, you may want to be a little more granular rather than doing a chunky, 1,000 crores, 2,000 crores. So I think the granularity is not by just retail alone. Granularity is within the businesses, because to keep the economy growing, like all of you pointed out, you can't do it just by one. More people buying cars, who's going to manufacture the cars? More people buying homes, who's going to make the homes? So you need to be in that space. And we, at least in the bank, here's a plug for Federal, for last 10, 12 years, we've been reasonably balanced across the spectrum. Right? At this point in time, and you can look at many slices of data, roughly 55, 45, 60, 40 kind of mix we've had. Yeah, in one quarter it may be more, one quarter it less, but that is entirely dependent on the opportunities in the marketplace. At this point in time, I hold the view, I think similar thing Mr. Sethi said, it's not constrained by credit demand, it's constrained by the deposit origination capability. But we all know money gets generated when money gets spent. The wheels of the economy have to move. M3, money has to be in circulation. And for money to be in circulation, you need to create demand. Demand has to create more money. So I don't believe deposit creation will not happen. For that, the economy has to be lubricated. We are at that cusp. I do believe in FY24, for the deposits play will be a lot better than it was in FY23. I think there will be more money coming into circulation, and credit dispensation has to be equally weighted in the entire range of opportunities in the country.
Yeah, I think that's a very balanced view and it makes a lot of sense. But let's see how it goes. You know, this still seems to be under a lot of churn. I'll again switch over to a slightly different topic, which is, PD Singh is now looking at me, so I'm going to direct the question to him. He is in India, but unfortunately or fortunately, he represents one of the largest and most well-known institutions, banking institutions of the world. What is happening in, my question doesn't end here. What is happening in the US banking and regulatory system? So I am also associated with RBI. So they are actually amazed. And as are many others, Silicon Valley Bank, this bank, that bank, and the nature of what happened there, at least some commentators seem to suggest that this is, so elementary that not just the bank, but somebody should have told them that, this is just not on. That's the first part of the question. And from that, I'm moving on to a slightly broader thing, because that is linked to this theme of harnessing banking, because you can't harness without raising capital. And then if, the ones who will provide capital, they see all these things happening in their own environment, they'll think things are much worse in a emerging country like India. So first, is it really a very small kind of thing, confined to a few institutions, it has been managed and certain things will change, or can it have larger ramifications? Because just to, give the counterpoint to that, is that UBS Credit Suisse is not a small transaction, So how do you see this play out, and what implications can this have for India?
No, thank you. Thank you, Mr. Basu. I think, firstly, congratulations. This is the multiple years in the making where you have had this conference, and congratulations to IMC for, I think, third, fourth year that I've been associated in having this conference and making it such a big success. Coming to your point about what's happening internationally and specific to what's happening in the banking sector in the US, I think we forgot about interest rate risk when we were only looking at credit risk. So I think what you said is very right. The very elementary part of risk management was forgotten. So when you had securities which were carrying an interest rate risk and you forgot about them and you didn't mark them up correctly, and then you had to dilute them to meet your depositors' requirement, obviously you had to show the losses, which led to stock price going down, which led to a domino effect on certain banks. Again, I've simplified it very much, but there are a number of small banks in the US. A lot of them have faced scrutiny by their own depositors. They were serving niches which were very much required in a deep economy as there is in the US. So very different from India, where most banks are clones of each other in terms of the way we do business, the breakup between retail and corporate. Many banks are focused on SME as a niche, and many times they see that as a stress sector. Many banks were focused on large corporates in India, and they saw that as a sector of stress. However, banks in the US that were exposed to niches are now definitely seeing some kind of stress. Is it something that will blow up into something, into a very large economic event in the US? I would say the house view of the institution that I work for is not, it will not have that kind of an impact, given that it is across isolated institutions. In an open market, panic does, spread very quickly. we do see concerns that magnify, many of them unjustifiedly so, and withdrawal of large amounts of deposits. So as I think as long as the overall constituents in the banking sector are behaving as they do now, which is not to encourage these flight of deposits from smaller banks, and making sure that the overall story is properly understood by depositors and investors, those risks are minimized for the time being.
Okay. I'll just carry you on to the next part of my question, which is about the ability of Indian financial institutions, Indian corporates, Indian financial institutions to attract foreign capital. Two parts to that question. One is, how is it actually? On paper, a lot of things look good, but in reality, what it is. And the second part is that, some news or the other in India, we have a recent past, we have had news items which are not too healthy for the corporate India story. So is it in any way impacted thought process? ESG, for example, is there any? Just to get a flavor.
So to answer the first part of your question, there is a huge appetite in the international market for Indian paper. We've seen that in every time we've gone. I myself have met investors, and the last time was with Mr. Sethi. The only question they ask us is, why is there not more issuance? And we're talking about debt issuances from India. Why are there not more long-term debt issuances or papers coming out of India? So that is the good news, that there is appetite. The bad news, or I can say more good news, is that we've seen $52 billion of inflow from Jan till now already. The bad news is, as emerging markets, overall FDI across all emerging markets, and this is not an India story, so let's be clear about that. All emerging markets have seen a reduction in FDI come in as the rates have gone up in developed economies. So as there is a competition for capital, some of the more risk-averse capital will continue to stay in their home countries or go to safe havens, and that is what we are now competing against. So we may have to pay a little more, or we may see a temporary gap in the capital coming in. But like I said, for good institutions and for the corporate and financial institution sector in India, there is a huge demand for Indian paper for the longer tenor at the right price. There are windows of opportunity here. We've seen 3 Indian banks already raise money since January, which includes State Bank of India, HDFC, Exim Bank, and one other PSU institution also in the finance sector. So all in all, I would say a good story for India. The headlines related to certain corporates or certain events, people are curious. I wouldn't say that it doesn't have a negative hangover, but it is quite easy to explain, and I think we have the credibility now after the banking sector cleanup has happened over multiple years. So that credibility is carrying the India story forward in a pretty strong way, I would say.
Right. I think that's a very reassuring view. And given that reassuring view, I will turn to Joydeep, because PD is assuring us that money is there. So if you have to raise capital, you can raise. So go on lending. Today it is 18%. Bank of Baroda is one of the largest banks. You can go up to 25%. I think that is something we reached in early 2000. Banks were growing at 24% and all that. Given that scenario, my question is a little more nuanced. Corporate we discussed, and I think all banks will probably lend to corporates, including Bank of Baroda, but you will lend to good corporates. Now, where at least if my data serves me right, where public sector banks, SBI, Bank of Baroda and the others are losing out to private sector banks is in the MSME space, right? And, what is it that you feel as a strategy should be done to counter this, which means that MSME is going to be the bread and butter. I'll just quote something which the SBI economist, Dr. Shomokanti Ghosh said in the morning. He said some survey had shown that there were, in 2019 it was done, that there were 6.4 crore SMEs, of which 99% or 95%, something like that he said, are microfinance institutions. So a very large number. Then the interesting data that he gave is with the Udyam portal coming in, now there are some 1.75 crore registrations, and maybe you can take a break up into MFI and this thing. Increasingly, I find that not only private sector banks, but NBFCs, we had a very engaging NBFC session, just after lunch. They are doing a lot on the MSME space. What is it that the banks can do more, and if so, differently?
I think that's a very pertinent question, Basu sir. And of course, MSME has, of course, traditionally been a challenge for the banks, more so because I think a large part of the MSMEs were in the informal side, not yet on formal stream. The position is no different still, because still we have a lot of MSMEs still on the informal side. Another problem I think is also which the banks face is more on the data, or the data availability, or the formal sources of data, I would say, to underwrite for an MSME. So that again is something which has been bridged by NBFCs to a great extent, which probably the banks have not been able to bridge as easily. And a lot of that has been because of their presence on the field, their ability to do field investigations, take alternative data sources, or base their credit decisions on those alternative data points, etc., which still are not available, or largely not acceptable in a banking context. So that is, I think, what has been traditionally the MSME space, and why I think the banks have not really cracked the piece here. Also, I think a lot of in the MSME space, the way for the banks, as the banks also are getting into this arena, is the whole aspect on digitization. As you digitize more, and as you have very well constructed scorecard driven lending, cash flow based lending, then it becomes all the more easier to grow in outreach, cater to more number of MSMEs, rather than do things which are not really digitized or partly digitized. So that is one way in which banks are actually adopting to address this problem. The second is, I think, the whole aspect of partnering with the NBFCs. And that is a trend, I think, which has started, but will grow in traction as we go ahead. And it serves both. The NBFCs, of course, they have the issue of funds. So while they would be much better in terms of their model, etc., to get to the MSME financing space, but at some point in time they are limited by the funds, which banks are not. So there has to be a partnership where both NBFCs and banks can come together and fund this space. So that is, I think, where the co-lending and the other opportunities are emerging. So that is where I think we will be able to address this in a much more holistic manner.
No, I think so. And, we have been talking of the India stack for a long time. And right now, I think broadly the shape of it is, becoming clearer and clearer. I think ONDC, to my mind, UPI is one big thing. And ONDC, for example, is this open network for digital commerce. Whatever statements I read of the CEO, if even large part of it is true, that is something for the banks to capture. But what the NBFCs, to my mind, have been able to do, and some of the smarter private sector banks have been to, which you rightly said, we go for more structured data, in a structured fashion in the public sector banks. But to look at surrogate data and then it's just not CIBIL score, just going beyond CIBIL score, that will be very important. So, thanks, we'll come back to you, but Srinivas, one question. Now, the first part was all gung-ho and we are all ready. But when we have a banking CEOs conference, have we forgotten about, is risk no longer a material fact, right? So last, I think, 2015 onwards, it was all, risk, risk, risk. I know that credit risk is under control, but what is your sense of, two questions actually. One is the broader question on what are the principal risks that the Indian banking system is currently seeing, and how is it being addressed? It can be any area, whether it's operational or market, liquidity, whatever. That's the broader question. And because it is a bank, I think credit risk remains important. Where are we? We are definitely strong on capital, strong on net worth. Credit costs have come down. But how much are we really better off in case some crisis were to come up? And something or the other will come up. It may not happen today or tomorrow, but it may happen. So these two questions, if you can take.
As far as risk is concerned, in one of these similar forums, somebody said, risk is an inch wide and a mile deep. I think that is something which we always must remember. I think risk is never away from financial markets. I think we deal with risk, right? Our job is to deal with the risk and assess the risk properly, mitigate the risk and price the risk. I think these are the three fundamental aspects which we do as a banker. So while the preponderance of risk in our minds is always credit risk, because we presume that the money which is given is to be recovered because we have a fiduciary responsibility to ensure that the depositors are protected. From that point of view, the emerging credit risk need not be from the corporate credit. It need not be even from the retail credit. I think it would be mainly on the way we manage the credit, whether it is retail, it is MSME, or agriculture, or corporate. I think this is going to differentiate the institutions, the way they are handling the credit. For example, a lot of people keep asking me that, now that you're not talking about the corporate credit risk, are you building so much risk on the retail? I said the retail portfolios of each of the lender is completely different from others. The way we do home loans is not the way the others are doing. So where is this risk emanating is not in terms of the portfolio or the product or the process. It is the governance of this portfolio at the individual institution level. I think that is going to determine the risk which is emerging. So, for example, if you take the microfinancial institutions, what are those governance standards which they are following? And NBFCs, what is that the assessment and the quality of standards which they are applying and underwriting? These two have an aggregate risk impact on the banking sector because we are the largest lender to both NBFCs and MFIs. So the bank books may look good in terms of their own portfolios, but what is happening on the wider portfolios which they are creating in the system? I think that is what I am really worried about. So it is important for the larger lenders who are helping in on-lending and further lending to the MFIs and NBFCs. We must ensure that the similar standards of underwriting and similar standards of monitoring, similar standards of collections are followed by the underlying institutions also. So I think that is one risk feature which I will definitely mention. And in the operational risk, I think a huge amount of digitization which has happened has also created a huge operational risk for us. And it may, in an individual unit level, it could be small, but in aggregate level, the operational risk which is happening is going to be significant if we don't have proper mitigation measures, both in terms of the use of technology like AI, AML models to proactively manage this risk which is emerging on the digital transactions. I think there is another risk which we should be mindful of. And the third and most important is that, again, I'm coming back to my favorite topic in terms of the climate transition. Are we able to, I think if you talk about climate transition, I think it's too early for us to talk about scope 3, but how our customers, our corporate customers are getting prepared, geared up for facing whatever is commitments which we have made for the emission reduction, and are we preparing them for the transition? And if there is not only about the transition financing risk which I am talking about. See, suppose tomorrow somebody decides that I will not buy steel which is not green enough. What is going to happen there? So I think the regulator is also mindful of this emerging risk. And today it is asking the banks, you need to have engagement with your customers, that how are they getting prepared for the ESG risk which is emerging. I think broadly, these are the ones which I can immediately talk about. I think there are quite a few other risks, of course.
Yeah, I think all of them are important, but the one which probably gives, other than credit, is cyber security risk, that is not just for banks, but for every institution. I turn back to Mr. Srinivasan. Shyam, one question now. This was actually asked by one of the participants to one of the panelists in an earlier session. And this is that, RBI has already put out the draft guidelines, I think, that Indian banks will be moving to an expected credit loss system. And expected credit loss system, in fact, interestingly, is already in place. NBFCs do it, to a large extent. Maybe it will get further tightened. And I think the question was around, some report. I haven't seen that report, seems to have come, which says that the impact on the net worth of Indian banks will be huge. It has probably just come. And very interestingly, how analyst outside the banks get to know about the bank's balance sheet beats me, but then they are very smart people. So one is, I don't want to ask about Federal Bank, you would have done your own assessment, but broadly, you are a veteran of the banking industry and been around in various banks. How do you, in the short run, is there really a negative, going to be very much a negative impact which will, impinge on the ability of banks to grow fast? And in the medium long term, how do you see this? Is this a better measure than the IRAC system?
Thanks. Before I answer this, Mr. Basu, one point I'll just add to what Mr. Srinivas was saying on the risk, which I thought is relevant. I think the big issue on risk is maybe under mentioned is around a leadership risk, because many banks have a model which is either, say, they were born through a wholesale model which has become retailized, or born through a retail model which is getting more wholesaleized. In both, the management of risk is very different. So if you come through a wholesale system, somebody walks in and says, sir, there's a 5 lakh credit problem, you will ignore it. And many 5 lakhs can crop up to becoming a big problem. So I think the biggest issue in the risk management is our business model and our risk sensitiveness, leadership level, not just at the senior level, verticals. And therefore that is going to emerge as a very big challenge. And how do banks cope up and build capabilities to be sensitive to a 2 lakh case and a 2,000 crore case is going to be a big challenge as we move forward, particularly with this shift in business models and many looking alike. Turning to your other question on ECL, I think the report you're probably referring to is one of the more recent one that's come out, and they've called out saying maybe 3 to 5% of the net worth of many banks can get eroded. So there are 2 points to this as I see, whether it's 3 or 5 or 2%, there will be some impact on the ECL, largely because of the fact that the books that you look back on, based on which you calculate your PD and your LGD, belong to a period where some banks have had extreme stress. So to that extent, the model may reflect a higher risk, and therefore the likelihood of the expected credit loss being high is likely. But there are 2 parts. One is the management of that hit, whether it's a one-time hit or a multi-year hit, right? And that's a regulatory call and the forbearance that may come in and how it will get smooth landed. The better and the more important question is it a good thing to do? We have seen even in the NBFCs or the companies we lend to, or we have a small NBFC which is part of the bank, I can see the thought process of the leadership changing substantially once they apply this whole philosophy of ECL. Because then the question is not, okay, we can get away by lending today and 1 month later, 1 year later, the book, because you're then seeing the likelihood of loss across periods of time. So directionally moving to an ECL model is good. Whether the consequence of moving to an ECL model on day one, will it have a massive impact on some banks' balance sheet and net worth, and how will it get dealt with? I would think that will have some kind of a management of that transition, which I'm sure the regulators are acutely aware of and are looking at, and the discussion papers that are in place seems to suggest there may be solutions around it, but directionally I think it's a good thing.
Yeah, no, I fully agree with you. I think directionally this is an improved system. No one will dispute that. When you say that we are recognizing the true loss or the true recovery in that asset, I think it's probably the only fine tuning, and with technology coming in a big way, is how do we actually calculate that? How accurate are we in our calculations on PD and LGD, etc. But directionally it is good, and I think in the long run it will be taken as a strengthening of the Indian banking system. That will be the, even PD can allude to that, whether it will be taken as a strengthening of the regulatory system of the by India. I'll turn to you now. This is, you gave a good color again on foreign investors, very reassuring color. But you understand the Indian markets also very well, operating in India. And this question I always ask, because I have never been able to crack it. For the last, I think 1986, there was a Chakravarti committee which also said we want to deepen the Indian bond market. And we are now almost 40 years since then. And some developments have taken place, but the Indian bond market doesn't seem to have developed. Are the recent steps that have been taken both by the players and by RBI, do you see something significantly changing in this in the next 3 to 5 years?
So if we see the 10-year yield and how it's flat thereafter, it just shows that the long-only investors, which are the pension funds, insurance companies, are investing in government securities. That means this is not, this is a demand-side problem. This is not a supply-side problem. So there isn't enough long-term paper in the market, which meets the risk appetite of the investor in this case, for them to be able to build that market out altogether. So I think firstly, because 40%, or I would say doubling of all central capex is happening in infrastructure. Very little is happening from the private sector, and we know that is because of capacity utilizations which are in their low 70s. In that scenario, there is, like I said again, it is not a supply, it's a demand side problem. The supply side is open. So the good news is there is enough money for long-term assets, and as and when the investments happen and these papers are issued, I am sure this will develop into a vibrant market. As far as the short term is concerned, I think we have seen multiples of issuances. We've seen the market grow quite and become a pretty vivid and active market. Again, it is about pricing, it is about timing, it is about certain events and risks that you see on the horizon, which again I think is a pretty constructive environment as of now.
Correct. So on the regulatory side, you feel that broadly what needs to be done, given the current demand perspective, has been more or less
absolutely
taken care of,
yeah.
Right? So probably the question which is in the minds of everyone today when they attend a panel like this, I'll addressing to Joydeep, who incidentally is also looking after that in Bank of Baroda, digitization and fintechs. Right? It is there for everyone. No one now talks of how this will go and how it is. Sometimes even some CEOs have gone on to say that we can't understand whether we are a technology company or a banking company. I don't agree with that, but yeah, that's a nice way of putting it. So what currently is the situation? On three specific pointers I'll give so that you can address. One is, I know banks are collaborating with fintechs. How effective it is and what are the challenges in that? One set of questions. Second is on this digitization thing, and I link it because we can't have a debate or a discussion on banking without keeping the customer centrally. As digitization happens, is it really benefiting the final customer, or is it something which the banks are looking on only as a, something which will make us more efficient, productivity parameters go up, costs come down? And what is it there for the customer? And customer, if you talk to someone in RBI, they are extremely worried about customer protection, especially coming from this FinTech alliance. So FinTech, many measures have been taken by RBI. In this scenario, how do you see your bank responding, and in general, what should the banks do?
No, I think it's an interesting play going on around here. So digitization, the digital economy is on us. Everyone is aware of how the India stack moved, and then from India stack we went ahead with the consent layer, the paperless layer, and now we are going into the credit layer, ONDC, all those things are getting into. But again, as we move more and more into digitization, and also the point that Satish was referring to the risks, I think digital and technology risk is it's a very, very big risk that I think is staring at our face, and we need to be cognizant of that. While there are a lot of things that are happening on the digital side, and we need to push the frontiers on the digital side as much as possible, because that is the only way you get to reach scale, you reach out, you increase outreach, the turnaround times, all of that is actually possible when you get into the digital bandwagon. But then there is this whole aspect of the technology risk, and that is something that we need to be cognizant, not just cognizant of, but keep taking care of as we move ahead, and it's evolving always. So that is one thing that I think needs to be always at the back of the mind when we are talking about all things digital. Second, I think as we are looking at this whole digital ecosystem and how it's evolving, I think from our bank's perspective also, I think we would be looking at one, of course, the payment play in terms of how the payment ecosystem is also enlarging the space there. And as far as the payment ecosystem is concerned, it has its own linkages with spending, with credit, with lending, and all that. So that again is these interlinkages have their own evolution. I think it's also when we look at this entire digital ecosystem, or it is an evolutionary journey. So it is not created or thrust upon us. Whatever we are seeing, it's actually evolving. If I look at our mobile banking platform, what we were 2 years back when we launched Bob World and what we are is hugely different. And that difference has come about only because of the feedback that we are getting from customers, from users, who actually say that they would want this feature, or this feature is probably not right, they would want something else there. And those are the feedback which are actually helping us evolve this entire mobile banking. And so it is for all the other channels in digital. So that is where I think there's an evolutionary journey, and the evolutionary journey is absolutely gaining pace by the day. And now AI is upon us. We never had ChatGPT 6 months back, now it's on top of us. And in everything we do, there's an AI which is being talked about. What can we do? So we need to sort of embrace. There's nothing that we can sit on the boundary lines and say we will watch things as they evolve. We have to jump along, get along, see what is it that is working, what is it that needs to be adopted, what is it that needs to be changed, and do the needful. So I think that is what we are also doing. That is what all the banks, I think, will have to do. And most of the banks actually are in the process of doing that. And I think it's here and now, here to stay. So that's what I would say.
Yeah, very interesting that you finished with AI. because in the morning, Madan, who's now your chief economist, on a lighter note, in fact, very interestingly, he said that, we may not be having an economists panel in future, and then chat GPT or self-generative AI may take care, and very rightly then he said that maybe even the audience may not be there and we may not be there, in a few years' time. So on that note, I think we had a very useful discussion coming in, the voices, current situation of banks, etc. These were the questions which came to my mind, answered admirably by all of you. But I would like, this is being the last session, I would like questions which we have not thought of to come. Yeah. So I have noted, so we'll go to Mahendra first, and then Mr. Adi Kesavan. Surprise, you are right now in Bombay, or?
Thank you, Arijit. I'd like to go to what Mr. Shetty talked about, is the climate change and the ESG kind of risks. And PD and I were chatting during the lunch also. I think there are internationally as well as in India two forces working towards this. One is the investors and second is regulators. And to give it to a logical conclusion, I think the board of directors will have to look at it. So where is ESG being discussed, how deeply within the boards, and then how is management taking it? It's easy to say that transition is slow, everything cannot change, but we don't have that much of time. I mean, all of us know after COP15, we don't have so much time. So the view of the panel on ESG.
Yeah, Srinivas, and then from the private sector view, I'll request Sham also.
How fast banks are going to integrate this into their credit assessment?
Yeah, I think, thanks for asking this question. In fact, I have been spending a lot of time on this. I may not be able to speak for other banks, but in SBI, I can assure you that there's a great amount of discussion, both as an institution, that how we become a model for the ESG, number one. And for instance, SBI is the first bank in the country to have a second party opinion in terms of our ESG framework. Nobody else has. Second party opinion means you get an independent assessment of your ESG framework. And that is publicly published and put on the website. And most of the investors look at that framework and the second party opinion. And the second piece is that we are so actually are involved and engaged in terms of the ESG implementation. We thought we will start with our own liability management in terms of the greening our liabilities. And we raised the largest ever social loan in India. I think the first social loan raised in APAC region is HDFC, and the second financial institution and the first bank in APAC region is SBI. $1 billion we raised in the social loan. And the third piece is, I think it is not only about, again I'm coming back to your question in terms of what is the kind of discussion which happens in the board, and how do you dovetail your commitments both at the national level, 2070 net zero commitment or 2030 emission reductions, and also the regulatory expectations in terms of moving to scope 3 with your engaging with your customers. The whole thing has to be dovetailed into a credit assessment, right? But this is a long journey. I keep asking everyone, suppose tomorrow I say that every steel company which is not adopting to green steel will have to pay 1% more. It is not going to work, right? So I think our credit risk models have to be aligned to show to the customers that your score is coming because you're not there, you're not moving there. And also engage with the managements of these companies, our customers, that what is your plan? What is your plan to move there? So I think it is initiated. And the other point which I would like to mention is that why it also attracts the attention of the board is we run some of the largest multilateral programs in the country in terms of the ESG, particularly in terms of rooftop solar, in terms of ground-mounted solar, in terms of the EVs. We run the largest programs with the help of the multilateral institutions. Bring the visibility into your boardroom that we are able to raise low-cost liabilities for the bank because we are committed to the ESG framework. I think this is very important to start. I think no board, no management will pay attention unless you show a concrete benefit of talking about them. I think that is what we have initiated in SBI. Thank you.
Just for, I think very
Yeah,
creditable.
let me
This
just
is,
take up.
big, much more development since the time I left, which I am very happy about. Yeah, Sham, Mr. Srinivasan, would you like
No,
to
let
add?
me just add to what Mrs. Sethi was saying. See, this is the sort of unfortunate part of size. Most don't know IFC's first and only green invest equity is in Federal Bank in 2021. They hold 5% of Federal Bank and they came in only because of our ESG philosophy. And we've made, long before it's sort of becoming more structural or regulatory requirement, and looked at ESG not as an obligation but as an opportunity, right? And we've made proactive commitments that we will be coal zero by 2030. And in every credit proposal that the bank considers, big or small, it goes through our ESG practice. So we have made, of course these are evolving, but institutionalizing the whole underwriting practice of credit to ensure that it will pass the ESG smell test or ESG test. And we've put out publicly our disclosures on what it means. And this, to the extent that I'm quite happy to say that IFC is considering the next capital opportunity to take additional capital if permitted to come into the bank, only because of the practices are getting more sort of detailed into. On our own, we started a green deposit scheme. We raised 2,000 crores retail deposits, on which we will set aside or earmark towards greening and social commitments and stuff like that. So in some ways, it's big and small. SBI is 25 times our size, but as a practice, it's getting instilled, and the more proactive, more forward-thinking organizations and boards are right at the cusp of it. I don't think any longer we can be on the fringe and in the periphery and say we'll watch this go. It's now central and almost integral to the conduct of the bank. And like the others have said, capital will come and investors will come, particularly global investors. They are very sensitive to this whole space of how responsibly is money being deployed and which areas it's going in. And it's not just about coal zero or some of those. It's the whole social governance aspect and how the whole thing is being played out. So I think it's evolving into a main boardroom discussion, no longer a peripheral activity.
Yeah, that's the encouraging thing. Adi Kesavan, please. Yeah.
Sir,
Final question.
Only just 2 points, sir. One is, when we discuss this credit deposit disparity or credit outrunning deposits, we also have to remember that the investment portfolio for the system is about 7% higher than the regulatory. So how do we reconcile this anxiety of the credit deposit ratio incrementally and the higher investment, number one. Number two, sir, I find the inclusive growth, why it has not come up in this discussion where we are talking about pivotal role for driving the economy, because with a per capita income which is below the top 100 countries in the world, is that not something which we should be talking about? Thanks for your time.
No, I fully agree. In fact, Adi Kesavan is someone who writes on the second aspect. So maybe Joydeep would like to take that on inclusive growth. Yeah.
So I think very rightly pointed. I think as we are talking about and being a banking conference, it cannot be concluded without having a word on the inclusive side. I think for at least the public sector banks, for that matter, I think we have got a great sort of a base of Jandan accounts which was opened some years back, and that is a base which probably banks have really not done enough about, and that is something which will again fuel the next level of growth as far as inclusivity is concerned, because again that is a base which is aspirational, which again is very, very informal. You do not have data sources there to do structured sort of lending or any other forms of financing, etc. But at the same time, they are moving up the chain. So what do you do about that? And that's a huge base. For just Bank of Baroda's, in Bank of Baroda's system itself, we have a base of almost 7 crore such customers, which is huge. And probably SBI would be having even more. So similarly other banks. So that is something I think which will again drive a next level of growth, and it will require a lot of interventions in terms of thinking through what needs to be done for that base. And there could be a lot of, I would say, innovative approaches to looking at solutions for that financial inclusion, for that group, which could not just be lending but also savings. So which is to also address the question of how do we increase the savings ratio or the savings habit in a larger population.
So just to add a number that I heard yesterday at an IMF event, India has 1.25 lakh PIN codes. 99% of these are covered by banking activities and also markets. There are only 35 PIN codes that don't have proper banking. So that is a very wide coverage, I would say. So 77% of all adult Indians already included in the banking sector. 35% of these accounts are already active on the digital ecosystem. So, and that's increasing rapidly as well. I just thought I'll mention.
No, they're very useful. Srinivas, would you like to take the first part, credit, deposit?
I think a lot of deposits which had flown in the absence of credit growth had moved obviously to the investment book, and that has inflated the investment book. Obviously, none of us would like to keep in the investment book as long as the credit growth is happening. But the positive side of keeping in the investment book is that today many of us are also able to raise liquidity, support the liquidity, even if the deposit growth is lagging behind the credit growth. I think the excess SLR position is helping us to support the liquidity growth. But having said that, over a period of time, the investment book eventually will move to the credit book. That is definitely is going to happen. And in fact, incremental investment growth rates are coming down. That is something which is encouraging as the CD ratios shoot up. The second piece what we must remember is that the very interesting thing why banks hold excess SLR. When you have an LCR requirement, liquidity coverage ratio requirement, if you are managing the LCR just about 100% as RBI mandated, is a very tough call for the large bank like SBI to just maintain 100%. So we tend to play a little more safer on the LCR front. And much of the LCR is supported with HQLA, which is coming from the G6. That is also some of the reasons why you end up having a little more than what you are comfortable with within the investment book. I think, Adi, hopefully we would be having a some mechanism to manage our LCRs in a much finer manner. But if you see, if you see the SVB, I take pride that large banks like us, we stuck to our higher LCR ratios. The SVB is not only interest rate risk, the liquidity risk also, right? The Fed had it acted and provided that BTS facility a day earlier, SVB would not have collapsed. So this is very important to strike a balance between various elements of running a bank. Obviously, you're all familiar with. Thank you.
Yeah, just on that, I would maybe just add one point on the inclusion point, I think, which we just discussed. It's also that banks are also expanding, not in a physical format, but also in a digital format, which everybody is seeing. There's one aspect of expansion which is also happening, which is the banking correspondence channel. And that banking correspondence channel has been exponentially growing. And many banks are actually now having very large plans on growing that channel so that they have a sort of an outreach and last mile connectivity. For Bank of Baroda, 1 year back we were just 25,000 BC points. Right now we have in excess of 50 152,000 BC points. That's expanded our outreach very, very significantly. Similarly, for many other banks. So that's where I think, and each of these BCs, it's a commission model, and this commission model is increasing. The amount of average earnings that the BC was drawing, say, 2 years back, in our case, I just give an example, it was just around 7,000-8,000. Now it's in excess of around 13,000-14,000. So in 2 years, it's grown on an average. And that shows that this is also a channel which enables the outreach of banking, while physical branches may not be growing as much, but the BC channel, the digital channels, these are again outreach where banking expands and banking services gets to the last mile.
Yeah, that's probably the way to do last mile connectivity. But thank you very much. Really invigorating session for all of us. I gained a lot, especially because now connected with NBFC, but not so much with the bank. All the secrets of the bank are out. But thanks to all of you for a wonderful session. Thanks to the audience for asking the questions. And we come to the end of the entire day. So I think we have some program lined up. So, yeah.
Thank you for the session. After a thought-provoking, knowledgeable day, I request Shri Mahesh Thakkar, Co-Chairman, IMC Banking, NBFC and Finance Committee and Director General, Finance Industry Development Council, FIDC, to summarize the entire day's process.
Good evening, friends. I know I'm the 31st speaker after 30 speakers having been lined up for the day. I'll take not more than 5 minutes. I'll just conclude what good work has been done by IMC Chamber of Commerce and Industry today, and thank all of you for sitting the whole day throughout. Friends, we have witnessed one of the most wonderful, event today, harnessing banking and finance to drive India's growth. It went off very well with the beginning by, Honorable Minister Mr. Karad, who joined us online and gave us a lot of inputs about how economy is progressing, how financial sector is going to play a big role in the economic development of the country. The banks and NBFCs, finance companies are doing well, and how we all can reach MSMEs and small businesses to see the financial inclusion growth being met. He personally requested us to see that we send a note to him and the suggestions which he can carry forward in the Ministry of Finance and the Reserve Bank of India. We had Mr. Kabra, the chairman of WRC ICI, who spoke very well from the borrower's perspective and loans for the entrepreneurs and the startups, etc. He also made one of the points which was very pertinent in earlier times, like, banks say they have given this loan is sanctioned but not disbursed. That's not true anymore. In fact, nowadays the banks also equally fast and flexible to give the loans like the NBFCs that do it. We had our president and our chairman, Arijit Basu, spoke in the inaugural session. We lined up for you, as you know, 5 important panel discussions. The first one was by the economists. Friends, this was, moderated by Rumki Majumdar, who Deloitte. She was present here. And in fact, as a student of chartered accountants and law, I know that economists are known to be giving the views which are conflicting, contradictory. But here it was not so. No negative news. They talked all the way positive to see that how we all grow together and give the suggestions for the same lineups as the event is positive development for the country. Thanks all the economists for giving such encouraging remarks. We had a technology session in the afternoon, pre-lunch session, which is fintech. Today's technology is the buzzword. Nothing can move without technology. In earlier times, we used to think of business first and technology later. Today, technology first and the business comes later. If there is no technological product or the provision for that, perhaps we cannot do that business. And we banks and NBFC, we know very well how important today, and they play a huge role. Today it is all merged together and we are into competitive collaborative systems. We had a lunch, and after that we had a session on NBFC, which is of course my subject, as you know. And we talked about how NBFCs can reach MSMEs and small business loans, and also how banks can collaborate for this purpose by this co-lending and other models which are structured. We had State Bank of India representative also in the session. Apart from all the NBFCs, Mr. Narendra moderated this very well. And IMC being the chamber for the small business houses and MSMEs, it worked out very well for the delegates here. and they can reach directly to us for whatever queries they have got, but we will reach it to the speakers and see that your requirements for the small loans are met by all these NBFCs and banks also, and your suggestions which were taken very well. In fact, today this is NBFC session, so I would like to add 2 lines here, because today in a much better position. In last few years, we have done very well. Q4 of last year and Q1 today, we have survived COVID times and performing very, best with great numbers. We have, I said 30 to 100% growth has been registered by the NBFCs in last 2 quarters. It's phenomenal. Demand is exponential in India, and credit-hungry country with the growth story unfolding. MSMEs are going through the major credit crisis after COVID-19. There are 64 million MSMEs, and only 14% have a credit access to the banks. So that's why we need to grow MSME funding and find out innovative ways, and we have found many such ways today here. Friends, banks and NBFC will work together for this purpose to see that the gaps are filled. We had a session on insurance and mutual fund. After that, we talked about the penetration ratios to be increased, savings and investment schemes for the benefit of the small investors, and how we can mitigate the risk, also keeping our savings and investments safe. I am just rushing through because what we will do is, of course, the whole synopsis of this entire event will be available on website, as well as we publish a booklet after 1 or 2 months. We'll give the synopsis of each speaker's theme points, and which will be distributed widely to the people. We had a last discussion which we are seeing, the speakers are present here. Our chairman, Mr. Arijit Basu, moderated this, and this was CEO roundtable. We had kept best for the last, of course, with the great panelists speaking here on the risk appetite, risk perception, risk management, which is all necessary for all the banks and NBFCs, the financial sector. Today, even if the sector-wise, we find sometimes IT sector doing well or auto sectors, but financial sector has been growing, like anything. If I may say, with 44,000 bank nifty, we are growing at a phenomenal rate. We can see we are doing very well. We have this technology which has come in very handy for all of us, and fintech, NBFCs and banks will work always together for the benefit of the country. You have this worry on the ECL, but sir, we have been following India since last 4 years, and we have digested it very well. We had some reservation in the beginning, but now we've learned to live with it, and perhaps banks, and it will not be done suddenly, it will be spread over time. So even if there is a risk, there is effect on the results, it will be over 3 or 5 years which will be spread over. Friends, at the end I would like to say that we of course know how to do our business. I have told my regulators and Minister of Finance always that they should enable, enrich and empower banks and NBFCs, and we know our business very well. We will be playing increasing role in the country's development and the GDP growth. Before I conclude, of course, let me thank all the people necessary. Of course, the first and the foremost, the sponsors, our institutional partner, Western India Regional Council of the Institute of Chartered Accountants of India, gold sponsor, Bellrise Industries, wealth partner, Incred Wealth and Investment Services, silver sponsor, Shriram Finance Limited, logo sponsor, Profectus Capital Private Limited. To begin with, of course, the Minister, the President, who led the team, the Chairman, Co-Chairman, Mr. Narendra, other committee members of this Banking, NBFC and Finance Committee, all the moderators, panelists, sponsors, as I said, press and media who is present in the large numbers here, you all delegates, of course, our worthy MOC Selby, she has done wonderful work throughout the day, and the last but not least, the IMC team. Friends, we got just last 10 days to prepare for this seminar, to put our act together. We were thinking how we will get it done. But to draw an analogy from IPL T20, which is going on right now, Sanjay, Bharti and the whole team worked overnight to achieve this target. And in fact, they hit sixers in all balls of last 2 overs and became an impact players and game changers for this event. You would not have seen this success without that efforts. For 14 days back, myself and Arijit Basu would agree, and Narendra, we were not so much confident about the grand success of this event. We will do much better and bigger next year, and we invite all of you to join us, and all the best to delegates, and wish you all the best. Thank you.
May I request Mr. Mahesh Thakkar to present a memento to Sri Chella Srinivasalu Setti as a token of our appreciation and gratitude. May I request Mr. Thakkar to present a memento to Sri Joydeep Datta Roy as a token of our appreciation and gratitude. May I request Mr. Thakkar to present a memento to Sri Shyam Srinivasan as a token of our appreciation and gratitude, which is currently online, sir, which will be sent across. May I request Mr. Thakkar to present a memento to Sri P.D. Singh as a token of our appreciation and gratitude. May I request Mr. Anand Singhania, President IMC, to present a memento to Sri Arijit Basu as a token of our appreciation and gratitude. Thank you all.